Good afternoon. You're all very welcome to today's CPD webinar, Research and Development Tax Credit, Risk or Opportunity. You will see the Q&A button on the bottom of your screens, and as all attendees will remain on mute for the duration of the webinar, you're welcome to input your questions here, and Tom will answer them at the end of the session. We will be recording this webinar and will provide you with a link via email after the event. We are delighted to welcome Tom Collins. Tom has a background in tax practice and academia for over 40 years. During this period, he has spent 25 years in tax practice, working with PwC and Deloitte in Limerick and Dublin, and for 2 years with EY in New Zealand. He is Director of the National Centre for Taxation Studies in the University of Limerick and is responsible for the management of a partnership contract with the Office of the Revenue Commissioners, through which over 2,000 revenue students have graduated on 3 different programs under Tom's management. Tom is also Course Director for the Professional Diploma in Contemporary Taxation, which includes modules on revenue law and negotiation, data analysis, international tax and artificial intelligence. Tom specialises in international tax and has a particular interest in relation to the taxation of intellectual property and tax transfer pricing. Today, Tom is also joined by one of your fellow members, Ali Abmant. Ali is a member of the CIMA Southern Branch Committee and has kindly agreed to facilitate the Q&A at the end of the session. With that, I'll leave you in their capable hands. Welcome, Tom.
Thanks, Jean. Hi, everybody. Hope everyone is well. Thanks for your kind introduction, Jean. I met someone recently who was retiring from tax practice, having worked for 40 years, and I was thinking, God, it's an awful long time. And then I realised when I retired at 66 in about 4 years' time, I would have worked about 48 years. So I always say the reason why I stayed on so much in tax is I love it. I love tax because it's always changing, every day, every hour. I was actually just doing a lecture recently at 11 o'clock this morning, and I was looking up an aircraft leasing thing with India. And in fact, there's a High Court case just been heard. So everything changes in international tax and domestic tax. And I suppose unless you've not turned on the TV for the last 2 weeks, you know that the whole tax system with Trump and tariffs and the way the world is changing from being very much a consensus-based reform to get to a more global and more fair form of taxation. And suddenly you have Donald Trump comes in and the world is turned on its head. So a lot happening in the world of tax. And this area in particular is a huge area internationally. Research and development tax credits are used by tax jurisdictions across the globe to encourage foreign direct investment into Ireland. Today I asked the question, is the R&D tax credit in Ireland a risk or an opportunity? And I'll try to answer that question as best I can during this session. The R&D tax credit is like the Triple Crown in Ireland, insofar as it's one of 3 measures in relation to intellectual property. Now, whilst my focus this afternoon is on the R&D tax credits per se, I do want to touch on the other 2 measures, which are very much first cousins, if not even closer, to the R&D tax credit. Let me explain why. First of all, looking at the R&D tax credit itself, it's an incentive for companies to carry on R&D activities in Ireland. Now, it's important to note that because it doesn't necessarily mean that you create successful product or successful service as a result of your endeavor. As long as you carry out R&D activity, you will potentially qualify for a very favorable outcome. The favorable outcome is, in addition to your normal deduction at 12.5%, you get a qualified tax credit at 30%. So the effective corporation tax benefit could be 42.5%. And that extends also to buildings that are used for R&D purposes. But it is important to note from the outset, and as we walk through this, I'll give you a few case studies, from real life case studies to Alexander Fleming and to a West Cork farmer who might have claimed R&D tax credits in relation to a journey from middle of Cork City down to West Cork. This whole R&D tax credit has changed quite a bit in the last couple of years because of but you may have heard of Pillar 2. Pillar 2 is the introduction of a 15% minimum corporation tax rate, which prior to Trump was being rolled out across the globe. We have it in our legislation. We have it. It's currently in force, and it's something that the very large companies in Ireland, about 1,600 of them, are grappling with it at the moment. One of the measures that has changed in recent years, as in Finance Act 2022, was the changing of the R&D tax credit to a qualified refundable tax credit. I'll show you what that means in a little while, but it's a hugely important and hugely significant change in the manner in which the R&D tax credit is labelled, and it makes it much more attractive post Pillar 2 for the very large companies. That change took place by means of up to Finance Act 2022. If you got an R&D tax credit, you could set it off against your corporation tax for the current year, throw it back against the previous year, and then claim the balance by way of a refundable credit. Now that option is no longer available, but that is for a particular purpose. That is to make it more attractive and to keep the attractiveness of Ireland under Pillar 2. And I'll show you that by way of example in a little while. The other big credit, or the other big incentive for IP, is Section 291A. Now, Section 291A is kind of an interesting history. Back in, I think, 2009 or 2008, a very large pharmaceutical company went to the Department of Finance looking for a patent box type relief, or an IP type relief. That pharmaceutical company ended up going to, I believe, the Netherlands, and the 291A regime was pretty much in the ether. Some companies were claiming, some companies didn't quite understand what it was about, but something happened in 2015 that was a game changer. And the game changer was post the OECD project on base erosion profit shifting, and post changes to Irish tax rules in relation to residency, quite a few companies moved what was onshore Ireland, companies that were claiming relief under Section 291A. And the biggest of those companies was Apple. Apple, some of you may know from a lot of media attention in recent years, Apple had what was called three stateless companies. Three stateless companies following changes in Ireland and following, I suppose, an investigation by the IRS and Treasury in the States. We were forced to change our rules, and Apple had to change their rules in relation to corporate residence. Two of those three companies moved to Jersey, but one of those companies moved to Ireland. And the reason why it moved to Ireland is that it had significant IP on its balance sheet, which could significantly reduce its tax bill. And so 291A, in contrast to R&D, is an incentive for companies to bring existing IP or to buy IP from a third party into Ireland. And for the smaller companies, it gives you an effective tax rate of 2.5%. Now that's somewhat eroded if you're one of the large companies by Pillar 2. The way the relief works is that it gives you a capital allowance. So if you're familiar with capital allowances for plant machinery, what I'm going to say to you is quite familiar to you. So the way the regime works is that it gives you a choice, option 1 and option 2. Option 1, you can claim capital allowances in accordance with your accounting depreciation. Option 2 is you can claim it in line with a prescribed percentage in the Tax Act. And the prescribed percentage is 7% straight line over 14 years and 2% in the final year. Now, you might say, well, why claim one against the other? Well, you might end up, for example, if you were Coca-Cola and you had your brand isn't going to be amortized from an accounting perspective, so you couldn't go for a 291A claim under option 1. You'd have to go under option 2, which is the 7% over the 14 years. The third relief is known as Knowledge Development Box, sometimes labeled as the first baby born out of BEPS 1.0. It was based on a rule or a concept known as the modified nexus approach, which in layman's terms mean it's a relief based on the amount of substance, real substance that you carry on in Ireland. If you think about what the whole international tax reform was about, it was to stop companies creating subsidiaries in tax haven locations with very little by way of substance. And as a result of that concern by the OECD, sorry, in G20, we were forced to bring in this type of relief. It does it by giving you an additional deduction and gives you now an effective tax rate of 10%. Now, interestingly, again, you may, if you were looking at one of these sessions up to a couple of years ago, you probably recall an effective tax rate of 6.25%, which was the rate. Now, when I say a rate, it's an effective rate insofar as it's the manner in which the relief is computed gives you an effective rate rather than being an actual rate itself. It does that by looking at what you're selling, whether it's a product or a service or a royalty, and based on the substance of R&D carried out in Ireland that's successful, the relief works in that way. So whilst it uses the same terms of R&D, research and development, as the R&D tax credit, which we'll spend most of this afternoon talking about, it's very different from the R&D tax credit insofar as the R&D tax credit doesn't look to successful product or service as a result of your endeavor, whereas the knowledge development box, whilst it uses the term research and development, it has to be successful. So anything that's not successful doesn't get factored into your formula. In all three cases, you must be a company. Now, why talk about this in the context of R&D? The reason why I talk about this is that the most favored tool by multinationals historically, and particularly in the last 10 years or so, and undoubtedly will continue in the future, is the taxation of intellectual property. It's where all the value is. If you look at if you take your Apple phone, how valuable is that? How valuable are the patents underpinning that? And they are extremely valuable. And because of that, stakeholders like the OECD, G20, tax authorities around the world have been very concerned to ensure that we introduce a fair tax system that recognizes substance rather than some sort of Cayman Island, Bermuda type company in giving relief. In all cases, the company, it must be a company, okay? But there's a huge interaction between these three reliefs in practice. And it's very much drives what's happened in recent years. For example, I mentioned Apple brought their companies onshore Ireland to effectively avail of Section 291A. Google is an interesting story. At the time, the double Irish structure was closed down, albeit with a 5 or 6 or 7 year window to modify their structure. The knowledge development box was brought in to give Google an alternative structure. But in reality, what happened was Ireland doesn't exist in isolation, and other countries' tax administrations, other countries' tax incentives have a direct bearing on the behavior of multinationals. And Google is a classic case of this. It effectively onshored what was in Bermuda back to the States and repatriated significant money back into the States. Whereas the likes of Apple and Dell and other tech companies brought what was offshore onshore to Ireland because of Section 291A. So we talk about research and development. Now, it's somewhat of a misnomer in the label because people refer to R&D as research and development. In fact, it doesn't have to be both. The way the legislation is framed, you can actually qualify for the credit for research, or you can qualify for research as development. So what's the difference? Essentially, research aims to generate knowledge with the expectation that it might improve a product or a process, whereas development seeks to convert that primary research into a product or process or service. It doesn't necessarily need to be successful. You could spend a lot of time on something, all qualifying, ticks all the boxes in terms of legislation, revenue administration guidance, etc., but it doesn't work. It's still good from an R&D tax credit perspective, but it's not good if you were trying to claim a knowledge development box relief. The effective tax rate is 42.5%, which is your normal 12.5% deduction and this additional credit of 30%. As I mentioned, the manner in which the relief is now presented is different because of the 15% minimum tax rate, which I'll speak about in a little while. And as I mentioned, It's also possible to get R&D credits on a qualifying building. So if you have a building that is wholly used for the purposes of R&D, you'll get it. In fact, the usage test is 35%. So the 5 key questions when you look at R&D activity are those, and these are the questions that Revenue in their guidance set out in detail. You can read those in your own time. But the key aspect to this is, what is the uncertainty that you're seeking to resolve, and how did you go about doing that? And when it comes down to, there's a lot of slides in this slide deck, but I always use the basic rule of thumb. If you sat up in a bar stool with your best mate, could you, in 5 minutes, describe what you were seeking to resolve? What was the technical uncertainty that you were trying to resolve? How did you go about doing it? And what was the output of that endeavor? That's essentially what the R&D tax credit is about. A lot of jargon, a lot of words, etc. But it's essentially down to, what was the uncertainty that you were trying to resolve? How did you go about trying to resolve that uncertainty? And what was the outcome of that? Whether the outcome was good, bad, or indifferent, it doesn't matter. Now, one of the really important things as we go through the slide deck is, it really is important to document everything that you do. Okay, and there are, in a lifespan of a research and development activity, there's a lifespan where activity before you identify the technical uncertainty won't qualify, and there's a time period after you resolved the technical uncertainty that won't qualify. And what's really important is that everything that you do is documented, and documented contemporaneously. Don't try to make a claim in 2025 for something that you might have done in 2022. You know, we're all human. We can't remember exactly what we did. And revenue commissioners or tax authorities anywhere will probably challenge you on that basis. The science test is is set out in revenue guidance. I'll reference later on kind of good research material on this for those of you looking at R&D claims. But the most common claim is in relation to experimental development activities. That is where you're actually seeking to put into practice primary research and development of products. And most claims are actually made, under that are under that banner, okay? And it's defined in the Tax Act as shown there. So it's activities that are directed at producing new or improving existing materials, products, devices, processes, etc. Okay, so it doesn't necessarily have to be a new product. It can actually be improving an existing product. Okay, so if your company makes bacon, for example, and sausages, and you want to improve the taste factor for a particular market, okay, how did you go about doing that? Okay, what tests did you apply? What expenditure did you incur? And how did you resolve that issue? So it can be the creation of something brand new, or it can be improving something that's already existing. Now, I always use these two stories as a benchmark for explaining what the R&D tax credit is all about. The story on the left is about a guy that set out from Cork one day in city of Cork, downtown Cork, was heading out towards Castletownbere. For those of you who know Cork, you'll know that road is pretty rocky. And the gentleman in the back of his van had a whole series of trays of oysters. Now, oysters are a funny product insofar as they tend to be very sensitive, and they will only mature in their own time, at their own pace, when certain things happen. And in a lot of cases, it requires gentle rocking so that the process of maturing takes place. When the gentleman ended up down in West Cork, he opened the van and found every single tray was open. Every single oyster in every single tray was open. And he realized, jeepers, what seems to have happened is the gentle rocking, maybe not so gentle, on the road down from Cork to Castletownbere actually created the environment suitable for the oysters to mature because of the gentle rocking. Now, he couldn't have claimed R&D tax credits. He didn't set out from Cork City Centre and say, do you know what? What I might try now today is I'll go down highways and byways down to Cork. I'll hit every bump I can possibly hit, and we'll see what happens. I reckon that. He didn't do that. He just happened by accident. Now, if he had set out with an uncertainty in mind and had documented his entire journey down in terms of his speed, the bumps, etc., he could have claimed R&D tax credit. The other big one is the development of penicillin, or the invention of penicillin, which was by accident, created by Alexander Bell in 1928. He was actually doing something entirely different. But one morning, he went to his laboratory, and hey presto, there was penicillin. I didn't set out over the preceding month or 2 months or 3 months with a technical uncertainty in mind. He was doing something else, and as an accident, penicillin was developed. Again, he wouldn't have if R&D tax credits existed in 1928. He would not have been entitled to claim credit relief. So, as you can see from the war stories, it's really important that you identify what the uncertainty is, and the activities that you undertake are carried out in a planned logical sequence. It's not like heading down to Cork. There must be some technical uncertainty that you want to test by doing a particular activity or activities, and you document contemporaneously everything that you do. And that's really, really important, the contemporaneous aspect to the documentation. Every part of the process that you undertake is properly documented and costed. So the output must be to extend the knowledge or capability in a field of science and technology. So again, it goes back to, think of the guy in the bar stool. Can you tell me in 5 minutes what it was that you were able to resolve? Because when you make a claim, and I know all of you guys are in the accountancy area, you will only be part of a team looking at an R&D tax credit. Okay, you will be the accountants processing the numbers, identifying the numbers, and putting an R&D credit claim into revenue. The really important person is a science person. And the real test that you need to satisfy yourself is, can you get the science person on a bar stool and tell you in 5 minutes or less in language that you can understand, because it'll be you that will primarily be interfacing with revenue to explain what it is you've done. Make sure that what was developed is documented, is in accordance with the various regulations, etc., that are here on this slide. Okay. Then you are in the ballpark of getting an R&D tax credit claim. Now, as I mentioned, the work that you undertake, it must be either the creation of a new or more efficient product. Okay. It doesn't have to be necessarily that. It can be a process improvement. And as I mentioned, success is not necessarily necessary, pardon the pun, but a record of failures must also be kept. So it's really important to try to identify the issues that a project manager or member would be willing to present as an advancement to an informal gathering of a group of peers. Okay, so having done the bar stool test, okay, can I stand up in front of my peers and explain what it was I thought to resolve, how did I resolve it, and what was the output of that resolution? So when you break it down using a traffic light system, I find this useful in terms of what might and might not qualify. At the core in green is expenditure that clearly will qualify for R&D credit. So creating a new process, material, device, or product design prototype is what we're talking about. Other qualifying R&D would be an improvement in existing projects, scaling up in production, resolving production problems, that require some R&D input and process improvements. Okay, and management input into those activities, okay, and the costs relating to that need to be factored in. What doesn't qualify, and if you look at this slide, and I'll flick back to the previous slide, you need to identify it's like the goalposts, okay? What is the technical uncertainty that you've identified, and how did you resolve it? And that details that window of opportunity. It's the expenditure incurred during that period that will qualify. Anything beforehand won't, and anything that is in the red zone here, this is the stuff that happens after you come up with the new product or service. Okay, what happens next to commercialize what you have achieved? And it's all the accounting stuff, it's all the IP stuff in terms of managing intellectual property, commercialization, designs solely for cosmetic or aesthetic reasons, packaging, etc. So it's really important that you identify the time period, the detailed design period, and it's that period and the costs that you incur in that period that will qualify. On the other side, if you think of goalposts, you're wide of the mark and you won't qualify. Now, just to give you a sense of the type of stuff that industry comes across and practitioners come across, I'm not going to go listing through them all here, but you can see there's quite a range of activities that potentially qualify. And what's also interesting is it's not just confined to manufacturing or pharma. You can also be in fintech area. For example, if you develop a new, faster trading system, in the agribusiness, manufacturing, engineering. So you've got a good array of examples there of what might qualify for relief. And again, I suppose the tax person in me, and it was right across the globe now, both for very large companies and even for the SMEs and mid-sized companies, it's really important that the tax people, the accounting people, talk to the R&D people to make sure that you trap and track the relevant expenditure. Okay, so and you need to understand what it is that's been carried out, and both parties need to understand what does qualify. Now, there's a lot of material out there. Revenue commissioners, I think their most recent guidance was July 2024. They've issued about 7 or 8 guidance notes, or probably more at this stage. And they are very, very detailed. They also set out in detail the format of a report that they would expect to see, because revenue by themselves are not scientists. If you present an R&D project to them, they'll do a desk audit. If there's a degree that they feel this doesn't make a lot of sense, they will engage an R&D tax expert or an R&D science expert to give them input into their advice. And there's been a couple of TSD cases in this area as well. So it's really important that the science people, your R&D department, and yourselves in finance talk to each other, identify the time period. The finance department needs to look at what I need to compute in accordance with the rules and regulations. So, for example, grants now have to be deducted. Okay, what type of expenses do I exclude? And again, the revenue guidance, and there's a very good book as well that somebody, Irish Tax Institute, Professional's Guide to R&D Tax Credit, KDB, and Related Reliefs by Ken Hardy. I think it's in the 3rd edition at this stage. That was republished late last year. That's a really good guidance note for you. Okay, so I always say to people, the revenue have issued on a whole raft of different tax measures, quite detailed tax duty manuals. If you prepare claims in accordance with their specifications, then you are on the right track. But it's the science bit and your science people talking to you so that you understand what it is. So back to the bar stool philosophy, as I mentioned earlier. Now, the amount of claims being made by companies has kind of plateaued around about 1,600 companies in Ireland. Okay, and the cost of the exchequer has risen, largely because the amount of claims that are being made have risen. But I suppose when you look at some concerns that people have is we're not claiming, even though they may well be in a position to claim. This was a survey done not so long ago by the Irish Tax Institute, and the most common issue was the anxiety over a revenue challenge or revenue audit as a result of the claim, followed by the cost involved to prepare the claim. Now, depending on the company you're working with, okay, your R&D people working with your accountants may well be able to put the report together. In certain instances, you may need to engage a specialist tax person who has quite a few of the big four firms, for example, all have R&D experts in their in-house. Most of them are scientists by nature. Okay. But you can see that a lot of the stress factors in terms of not wishing to make a claim is not to bring the attention of revenue onto yourself. But if you get it right from day one, go back to the goalposts. What was the technical uncertainty? Make sure we've identified the time period in which those goalposts exist. Okay. Make sure that you understand the science aspect, and then make sure that anything that's incurred after that is not claimed. Because I suppose one of the most common mistakes that are made by people is simply not identifying that which qualifies and that which is not. And a lot of it is ignorance of detailed rules and regulations that are available. And if you haven't looked at the tax duty manual from July 2024, you should do so, because you'll find it's reasonably comprehensible in applying in practice. So what's happened in the world of tax? Big change happened in Finance Act 2022, and the reason why we changed the manner in which R&D tax credits could be given were twofold. From a US perspective, the manner in which we used to give credits were not compliant with US foreign tax credit calculations, and were causing concerns stateside when they came to calculate their corporation tax back in the States. The other aspect is Pillar 2. Now, Pillar 2 is the application of a 15% minimum tax rate for large companies. About 1,600 companies in Ireland that are impacted by this, for whom they will need to file their first tax return under Pillar 2, I think in June 2026, only around the corner. Subject, of course, to what Trump might do next. But what we have done is, because the R&D tax credit in particular is seen as, if we were to rank the three R&D, 291A and knowledge development box, R&D would be very much up at the top, followed by the 291A, followed by the knowledge development box, which I think has only been claimed on average by about 15 companies every year. The other two are hugely claimed by companies in different circumstances, but the R&D in particular is huge. And it's particularly significant that if you look at the 1,600 companies that claim it, they tend to be part of the 1,600 companies that will be subject to Pillar 2, big pharma companies, for example. And the manner in which we give the credit has a real impact when it comes to calculating what's called the global effective tax rate. Let me explain by way of example. We have a company that has net financial income of 2,000. Okay, it has an R&D tax credit of 200. So without any changes in Finance Act 2022, its income, global income was 2,000, say tax at 12.5%, gives you 250. So that's its global current tax position for any credits. It would have been entitled to a credit in this example of 200, okay, which would give you what's called a global cover taxes of 50. Now, under the GLOBE rules, this is the minimum 15% tax rate. The way the formula works is that it would take the 50, okay, as a percentage of the GLOBE income of 2,000. Now, this is a very simple example, but it illustrates a key point. That would mean that in this case, its effective tax rate would be 2.5%. in that case, if we hadn't changed the rules, that company would have been required to pay a top-up tax of 12.5%, been 15% less the globe effective tax rate of 2.5%. However, we changed the manner in which the relief was given. We changed the categorization of the R&D tax credit to what's called a QRTC, which is a type of a grant. So if all the accountants amongst you will understand the difference in accounting treatment for grants. It effectively now treats it as a grant, okay? And the effect of that is that even with the same results, your global effective rate now goes from 2.5 to 11.36 when you take 250 as a percentage of 2,200 because of the relabeling of the credit, which means that your top-up tax, known as your QDTT, is 3.64% compared to 12.5%. So in one simple legislative change in Finance Act 2022, we didn't necessarily solve all the companies of relation to dealing with Pillar 2, but we certainly changed one significant point. That was turning the credit into an effective grant. Now, we did that by saying that under the old rules that I discussed earlier are shown there in the slide. On the new rules, okay, it's, excuse me, the rules are quite detailed. I'm not going to go into them in great detail here, but you have this example for your in your slide deck. But essentially, it now becomes an option where you can either claim the credit or you can claim a refund, and it's because of that optionality, it changes the nature of the payment to being a qualifying refundable tax credit, which gives you a much better result under Pillar 2, as we just saw. And that's just an example of, for companies in a similar situation under the old regime and the new regime, you can see that under the new regime, in addition to the globe effect, it also actually increases the amount of cash refund, sometimes referred to as monetization, that they receive in the first installment. So you can see an example here where you had a repayable research and development tax credit, or RDTC. Leaving globe aside for the moment, it in fact gives you a better result post Finance Act 2022. So increases the cash flow in year one. So that's the bit on R&D. Your colleagues have asked or have allowed me to make a little plug before I take questions. We've started a new program here in Newell. Ali was a past student of mine on our masters in taxation. We've replaced the master in taxation by a hybrid online offering called the Professional Diploma in Contemporary Taxation. And if you allow me for 2 minutes, I'll just go through what the program is about. It's ideal for people that are working in practice or looking for a change in practice or looking for upskilling in certain areas. Because it's the whole world of international tax, dealing with revenue authorities has become much, much more challenging than it ever has been in the past. The access to data, understanding the risks associated with AI, having spoke to industry, having spoke to past students and revenue, etc., we have come up with this new program, and it's a little bit different to programs in the past insofar as it's entirely online. Okay, and just give you an example of, I'm teaching international tax on this module or this course at the moment. So let me just talk you through what it looks like for my module, because I'm right in the middle of it. On a Friday, I release a number of videos on material. I give students mini case studies to do in their own time. The following Thursday, we have a live class using Microsoft Teams for an hour and a half. We capture key points from the videos. We answer the mini case studies, okay, and we have a discussion on what's happening in the world of taxation. So this evening we're talking about that case I referred to earlier in India and aircraft leasing, because we covered aircraft leasing in this week's session. We're also having a very good discussion on the whole implications of Trump tariffs, what it means from an Irish perspective, etc. Each week, students get assessed. So the assessment could be 5, 10, 15%, depending on the week. They also do blogs, and they do an end of semester exam, or an end of semester essay. There's no end of term exam that you might be more familiar with. So very much continuous assessment throughout the period. The program looks like this. So people came on the program in the autumn and did revenue law negotiations. Now, just to explain what that is, my colleague Kieran Gallery delivers that program and has been teaching revenue law to our partnership with Revenue, and teaching revenue law on different programs in UL for about 15 years. He's expanded that out to negotiating with Revenue, negotiating generally. He spent some time in Harvard honing in on his skills in that regard. It's really interesting. Someone mentioned to me recently that somewhere close to 75% of cases that go to TAC never end up at TAC, are negotiated by the company or their advisor and Revenue. So the whole art of negotiations, Kieran does it in a very practical way. He also hones in your skills in terms of interpreting legislation, because so much of what we cover today, there's some very fine points on that, and sometimes it comes down to a simple interpretation of what does the actual law say, not what you think it says, or what you imagine it to have said, or what some commentator said, but what does the law say? How do I read the law? So Kieran does that really, really well. A colleague of mine then, Patrick Buckley, does, and sorry, I should say, Kieran starts that in September, finishes end of October, okay? Then Paddy comes in. So all these modules are done sequentially. He comes in and does a very much practical based module on tax analytics for tax. So it's gives you a lot of case studies in relation to data, how to analyze that data, because for those of you who are either in practice or industry, the amount of data that's coming to you from all aspects is huge. And you look at it in the context for your large companies, you now have master files, local files, country by country reporting. So understanding what all that does, and can I look at that and interpret that and process that information as effectively as I can. So very practically based. Again, for both Kieran and Paddy, it's continuous assessment on a weekly basis. So it's not like your traditional end of semester exam. We give you off Christmas, bring you back in line with our normal students. So we're in week 3 at the moment. So I've just earlier described the Applied International Tax Law module. And then after that, okay, there's actually a break of about 6 weeks. And then you join up a number of different courses who do under the tutelage of my colleague Martin Cunneen, who is one of the biggest AI academics in Europe. Risk ethics, governance, and artificial intelligence. And what he does is, he gets you to identify a project in your organization that you'd like to test under key principles that he enables you to understand. So it's very much a practically based project assessment delivered over 5 weeks. Okay. The interesting thing in this, there's loads of information available on the website, or if you want to talk to me offline, I'm happy to sit down and chat to you at any stage. The really interesting thing for this as well is that there's actually 50% HCI funding available for the first 25 students. Okay. So it's a bit like Harvey Norman, when they're gone, they're gone. But we're now taking applications for next September. The other aspect of this is that you can actually take those modules on a micro-credential basis. So you might decide, you know what, I wouldn't mind listening to Tom for 8 weeks. I'll just do that. That's fine. You also have the choice that if you do this program and you do 2 other professional diplomas, either in UL or elsewhere, you can actually merge those 3 programs into a level 9 Master of professional practice, which we have, I think, graduating this year. I think we have about 30 people who have literally bolted on 3 different professional diplomas. So that might be something of interest to you. But as I said, more than happy to talk to you offline, or if you have any queries now, to discuss the feasibility in your own particular circumstances. It's all online, so there's no requirement necessarily to come down to you well. So I think I was asked to speak for 45 minutes. So
thank you very much, Tom. Thank you very much for putting up such a great presentation on R&D. So there is one question I have from one of our attendees today, and it relates to Trump 2.0 era. It's probably the area you will be interested to answer. So the question I have for you, Tom, is can you please comment on how Ireland's advantage of inviting companies for R&D on land will be impacted by Trump's administration and BEPS 2.0? That's the first part of the question. The second part is, will Ireland be able to keep its advantage, or we are looking for tech companies to reduce the R&D work in Ireland and moving some operations back to the US? Over to you, Tom.
Yeah, sorry. The first question was the preserving the benefits of 291A. Is that
No. It says, can you please comment on how Ireland's advantage of inviting companies for R&D on land will be impacted by Trump's administration and BEPS 2.0?
Okay. Trump, and I don't mean to be glib in my answer, is who knows? Because what I suspect, we've been here before with Trump to a certain extent. This is, I think what he's doing isn't necessarily about tax measures. I think he's trying to politically put his stamp down for eternity. I think in time, I suspect a number of his measures will be rolled back. That said, it's a big concern. It's a big concern for tech companies. It's a big concern for pharmaceutical companies. I think the Irish government are taking measures to try and scramble together to come up with what do we need to do immediately. It's interesting as a sideshow. Do we go to the White House for St. Patrick's Day or not? Knowing, not that I know Trump, but my vision of Trump is that he doesn't really care. But I suspect if I was asked, should we go? I suspect we should, because at the end of the day, the Irish American influence is huge. It's probably as significant as the influence Israel has because of its Jewish community in the States. So I think we're better to be in the house rather than outside in the garden, pardon my pun. And I think we do need to, as a country and indeed as a company, because what concerns me what concerns me significantly is all of the tech companies seem to have aligned themselves very, very quickly with Trump to a shocking extent. And that's very different. And that's kind of scaremongering, that kind of fear of what will happen next. That is of concern. In relation to, so I don't really know the answer. I wish I did. But I think from an Irish perspective, we've kind of been here on a number of different milestones over the years, and we seem to be as a nation very good at negotiating our way out of a tricky aspect. This is different because all countries in the world are potentially impacted by this, and that is different. And it's very different in the sense of, historically, with Biden, it was very much a consensus-based reform of international tax. Pillar 2 would not have happened if Biden had said no. But Pillar 2 now could be impacted if Trump says no and says, no, I'm actually rolling back on what Biden says. And he's, what's concerning with Trump is that, it's a bit like a family argument. Everything that Biden seems to have done, he's trying to reverse. And, we wouldn't have had Pillar 2 if Biden had said no. So if Trump says no, yes, Pillar 2 could be at risk. That said, your second question about R&D. The R&D is hugely important in Ireland. And I think one of the aspects from it's not just about tax, it's also about people on the ground. Do we have, and if you look at it from the bottom up approach, we need more maths people, we need more science people, and schools need to be as efficient as possible. Third level needs to be efficient as possible, because they feed into the whole substance of why you would locate into Ireland. Because with Globe and 15% minimum tax, the tax advantages are now being almost a sideshow. It's more the economic factors, so do you have the people? Do you have the infrastructure? We can't have every single data center in the country because none of us will have electricity. And if anyone has suffered from power cuts the last couple of weeks, you can imagine with every single tech company in the world relocating to Ireland, that could become a real factor. Do we have enough energy on the grid to feed all these companies? So I probably haven't answered your question, but I'm just giving you general observations. It is a huge concern from Ireland's FDI perspective. Of that, I have no doubt. And it's going to take a while, months, for this to be resolved.
Thanks, Tom, for your insights on this question. The second question I'm taking from the audience is from James Hogan. And he says, in terms of AI and using existing AI to build models to improve an existing process that may be carried out by a human and or less efficient process, is this an area that could qualify, and how are revenue viewing this at present?
I can't speak for revenue, but I have no reason to believe that any expenditure in that aspect would qualify. It doesn't necessarily have to be. The legislation doesn't talk about humans carrying on activities. It talks about the company carrying on activities. So if the company uses AI as a tool to examine a technical uncertainty and seeks to resolve the technical uncertainty using AI, I don't see any technical reason or legislative reason why you couldn't claim R&D tax credits. I'm not aware of the revenue position on that explicitly, but I can't off the top of my head say there's no specific tax provision that I'm aware of that would prevent you making such a claim.
The third question we have from our audience today is RNG relevant if you are pre-revenue or loss-making?
Yes, if you're loss-making, you can still, because of the manner in which the relief is now given, if you don't have corporation tax to pay, then you can claim the R&D over a 3-year period. If I go back to that example there, so if that company, for example, under the new regime, didn't make corporation tax or didn't make profits during the year, but had an R&D tax credit, which is the RDTC of 800,000, that could claim the 800,000 over the 3 years, as indicated, even though the company is a loss leader because it hasn't made profit. So that's one of the advantages of the new regime, is that it gives you that flexibility.
John, during the fourth question is, during your presentation, you mentioned a scientist. Can you claim the RNG credit for developing a software solution?
I believe so, yeah. Yeah.
Say so. Another question from the audience is, offsetting the corporation tax liability and refund balance for 2024 CT1, what periods can this be claimed over?
Sorry, can you repeat the question?
Offsetting the corporation tax liability and refund balance for 2024 CT1, what periods can this be claimed over?
Over 3 years. So you can claim
Over
it for
3 years.
24,
Okay.
25, and 26.
The next question I have for you is, what are the most common mistakes made in claiming RNG?
Yeah, I suppose it can be broken down into a couple of categories. It was eligible expenditure, first of all, claiming expenditure that's not wholly and exclusively incurred in carrying on of R&D. That's one of the most common, and it's kind of a low-lying fruit in terms of revenue looking at stuff. You can actually claim R&D tax credit even on capital spend on plant machinery. And again, a very common mistake is that the plant machinery expenditures is not appropriate, is inappropriately apportioned. Okay, so it's really important that the manner in which you claim and identify plant machinery is identified. And the other aspect is under the science test that eligible R&D activities have simply been overlooked, and the claim has been undervalued. And that's where I think it's really important that the accountant, the finance people, the tax people, and the science people work hand in hand, understand what is available, which is very detailed, online guidance from revenue commissioners from July 2024, and and make a claim with that guidance, literally on your table and say, okay, have I ticked all the right boxes? Because a lot of the mistake is just literally the science test, not understanding that you've actually carried on R&D. Like I was speaking to one of the patent agents many years ago, better not say his name, but he always made the point that he could walk into any company in Ireland and he could identify R&D, particularly in companies that hadn't even considered R&D. And a lot of that is simply ignorance of the fact of what actually qualifies, what is R&D, and then and that's probably, I'd say, probably the most common mistake, I would think.
Thank you, Tom. And another question we have from the audience: how far back in years can you claim R&D?
Yeah, there's a time period. I think it's 12 months after the year, so it's a little bit different. It's a little bit out of sync with your normal tax filing date, but I think it's a 12-month test. I haven't seen. That's where the eligible. No, you could. I've never seen a case where a company could make a retrospective claim for more than 12 months on the basis of an error or mistake. Potentially that's possible, but I've never seen it, because you can for any tax aspect, there is provision in the tax code to make an error or mistake claim if you didn't know about or didn't claim properly or whatever. I haven't seen that for R&D, but I don't see any reason why it couldn't be claimed. So that 4-year window is potentially available to you. But the problem with that though is, and this comes back to the key aspect I mentioned at the very outset, is that you have to have contemporaneous documentation. And if you're making a claim for something that you did 4 years ago, then you probably haven't contemporaneous documentation in place. And it's very hard to, I challenge anyone to figure out where they were this time 4 years ago and what they did exactly on the day. So that's probably where your difficulty will lie, not so much in what the legislation says in terms of time limits, but more from a practical perspective. Can you actually remember what you did 4 years ago? And the first thing revenue will probably shoot you down on is, well, what you're now producing is not contemporaneous. So sorry, we're not making your claim.
Thank you, Tom, for your questions and answers. And I'm very well aware of the time now. We still have 2 minutes left. Just one question, last question. I'll take on the last question, which is based on the salaries of R&D staff. So the question says, so most of our R&D expenditure relates to salaries of staff conducting R&D. Should we keep timesheets to record how they spend their time, or should we just charge 100% of the salary to the research staff?
I would strongly recommend timesheets.
Okay.
As with having spent 27 years in tax practice, I know the dread of timesheets, but it's in instances like this, timesheets and recording, units of time is really important with good descriptors of what was done during that time period.
All right. Thank you very much, Tom, for your time, and
Okay.
Appreciate it.
Thanks so much, Tom. Gosh, great interaction from our members today. So on behalf of SEMA Ireland, I'd like to thank you for your informative and engaging presentation. We really appreciate your expertise. And Ali, thank you for your time also. We appreciate your participation. Before we sign off today, I'd like to draw your attention to our upcoming CPD webinar, LinkedIn Made Simple. This has been rescheduled from the postponed date in January to Thursday, the 20th of March. So scan the QR code now to register, noting that even if you did register for the original date, you would be required to register for the new date, please. I'll include the link also in the follow-up email. So thank you all for joining us today. We hope you found it beneficial, and I'll send the recording and Tom's presentation shortly. Thank you all. Take care. Bye now.
Thank you. Bye-bye.